So welcome back to Financial Accounting and Analysis. And we're going to pick up in Part B right where we left off with Part A. So in Part A, where we stopped, we said with depreciation, get my head out of the way here. I'll leave my head right there. On the depreciation, we had to come up with a systematic and logical, my friend Mr. Spock here, logical way of allocate the cost of the asset over its useful life. Useful life is the period that the long-lived asset is going to produce revenues for us. So we have to come up with a systematic and logical way to spread that cost. And the three methods we're going to be looking at is the straight line method, and we call it straight line. So if you can picture an asset that's going to be depreciated or written off over 5 years, the amount of the expense each year is going to be the same. Under the accelerated method, we're going to recognize the bulk of the depreciation in the earlier years. We're going to use the method we're going to feature here is the double declining balance method. The result you get for MACRAs under tax is very similar to this. And then we have the production-based method, which is used when your useful life is not expressed in years, but as useful life is expressed in miles, like with a truck, or perhaps in the case of depleting, case of Exxon and the oil they have under the ground, the number of gallons of barrels of oil actually pumped out of the ground. So we're going to base the depreciation or the depletion based on the actual number of units that we use. So let's start with the straight line method. We know from our previous discussion, this is the one that is the most popular. So we're just going to spread the cost of the asset equally over its useful life. It's a very sophisticated formula here. It's 1/5 times, if the asset has 5 years, n becomes 5. So you take the, if we're looking at a piece of equipment here, you take the cost of the equipment, subtract out the residual value, just multiply that fraction, and you will get the, if it's an asset with a useful life of 5 years, you will take 1/5 of the difference between the acquisition cost and the residual value, do that over 5 years, and then you're going to end up with a book value that's going to be equal to the residual value. So remember, the residual value is our estimate of what the asset's going to be worth or what it could be sold for when we're done using it. So here's an example, and we're going to beat this example to death here, because I think we're going to go through it 3 times on each of the 3 methods. So our cost of our truck is $28,000. I can move my head there. Is $28,000. It's got a salvage value of $2,000, which means over its useful life, we're going to recognize $26,000 worth of depreciation expense, and we're going to recognize that over 5 years. So $26,005, that sounds like $5,200 a year depreciation. Let's see how good my guess is here. So there's my formula. Plug in the numbers. There's my acquisition cost is 28. My salvage value or residual value is 2,000. Multiply that by 1/5, and you're going to get $5,200 a year. So each year, down on the bottom, you're going to recognize depreciation expense of $5,200, which we know is going to reduce, like any expense, reduce stockholders' equity. And notice you're going to increase the contra account accumulated depreciation on the balance sheet. So depreciation shows up in 2 places. It shows up as an expense on the income statement, and it shows up on the balance sheet as well. So $5,200 a year. So each year, you're going to recognize $5,200 on the as an expense, but each year that accumulated depreciation is going to increase by $5,200 as well. So here you can see now the book value is the cost minus the accumulated depreciation. Now, this does not mean at the end of the year 2 that this asset is worth $17,600. At this point, we're not really concerned with the market value of the asset. We're just concerned of coming up with a systematic and logical way of allocating its cost over its useful life. So on the balance sheet, we'll have a record of what we paid for the asset and how much depreciation. Sometimes what companies will do is they'll just show the long-term assets, property, plant, and equipment net, and you have to go looking in the footnotes to figure out what the accumulated depreciation is. Then we have the declining balance method. Declining balance method is an accelerated method, which means the bulk of the depreciation is going to be recognized in the earlier years. Double, because we're going to take twice the straight line rate, and declining because we're going to base this not on cost minus the residual value or salvage value, we're going to take twice the straight line rate and multiply that by the book value, which goes down each year. Hence, double, because we're going to use twice the rate, and declining, because we're going to use book value. And we know from what we just did with straight line depreciation, the book value goes down each year. So we're going to get faster depreciation in the earlier years. So there's my very sophisticated formula. So with our 5-year useful life here, it's not 1/5, it's 2/5. But notice it's multiplied by the book value, and the book value gets smaller each year. So let's look at an example. Same truck, $28,000, $2,000 residual value. So we're going to recognize $26,000 of depreciation over the useful life of this asset, which is 5 years. A couple of little quirks, if you want to call them quirks, about the declining balance. Although we ignore the residual value in the depreciation calculation, you cannot depreciate the asset to below its book value. Also, when you use this method, when you reach a point where the depreciation under double declining balance is going to be less than it would have been over the straight line, you have to switch to straight line. And I'll show you how that works in this example. So here's my useful life. There's my full 5 years. So if you look in the extreme right-hand corner, you'll see at the end of the year, the asset has a book value of $16,800. So now you go to year 2, go to year 3, and so forth. So basically what happens is each year, it's 2/5 times the ending book value. But remember I said that your depreciation under double declining cannot be less than it would have been if we had used straight line. And we know the straight line, the depreciation was $5,200 a year. So what happens in year 3, if you took 6,248 and you multiply that by 40% or 2/5, you're going to get a number less than $5,200. So what we need to do in year 4 is we say, all right, how much book value do we have left? And it's 6,048. What's my salvage value or residual value? It's 2,000. So notice what we do in both years 4 and 5. We take 6,048, we subtract out 2,000, which is 4,048, and we got 2 more years left, so we take 1/2. So the depreciation under the accelerated method for years 4 and 5 is just 2,024. And notice that the ending book value, we brought the book value, although we ignored the residual value in our depreciation calculation, we end up with a book value equal to that amount. All right, so be careful with the last 2 years here. So you have to switch. Basically what happens is if your depreciation calculation would have given you a number less than the straight line amount, which was $5,200, then you have to switch over. So you figure out how much book value is left out, you subtract out the residual value, and if you've got 2 years left, you multiply that by 1/2. Okay, if you had 3 years left, you'd multiply that by 1/3. Okay, so that's double declining balance. And you'll get ample opportunity to demonstrate your knowledge of this when you do problem 734. All right, let's look at the units of production. So there is actually an example of this on, I don't have a schedule here to show you, but if you go to page 272, there's a nice example where you can see numbers being plugged in here. So here we'll use this when the asset's life is based on usage. And what we simply do is we take the acquisition cost minus the residual value, and we take the output, the total estimated output in the denominator, and in the numerator it would be the output consumed during that period of time. So if I skip over to page 272, for instance, so looking at the bottom here, you've got an asset that's got a useful life of 100,000 units, okay, and it cost 30,000, and it had a salvage value of 4. And the number of units used was 25,000. So you might want to pause here and go to page 272 and come on back, and you could see that how the depreciation expense each year varied based on the number of units actually consumed during the period. So this is used not only in cases of like depreciating assets where like a truck where it's in miles. This is also used when calculating depletion for oil, for coal, and so forth. Okay, so now we want to talk about impairment, and this has nothing to do with drinking and driving. We're not driving while impaired here. This is just asset impairment. An asset impairment is when we know that we record assets at historical cost, so we've got assets on the balance sheet, but what happens when the ability of those assets to generate future cash flows goes down, or so we have to adjust that. So, and when basically an impairment means a long-lived asset that's on the balance sheet has lost some of its value. So you got a lot of this going on right now in the COVID case. So those of you who are doing SMACs on COVID, you're likely to see, if you look at the results for the first quarter or so, you're likely to see some of these impairment being recognized. So impairment is when a long-lived asset actually loses some of its value. So that's what we mean by impairment. We also, in this section, consider the role of market value. So under U.S. GAAP, we generally don't consider market value, not for long-lived assets. We do consider market value. In the next chapter, you're going to see that we have kind of a violation of historical cost and conservatism. When we get to chapter 8, you're going to see that what's going to happen here is that we are going to adjust our marketable securities for the market value. But for under U.S. GAAP, we don't do that for our long-lived assets. We do, however, do it for international financial reporting. And we're also going to take a look at the sale of long-lived assets. So what happens when you sell an asset before you're done using it? What if you sell it? You know, is that that's going to give rise to, depending upon what its book value is and how much you receive for it, that's going to give rise for a gain or loss. So revaluing of long-lived assets. So we've got to write down, we got to do a downward revaluation of long-term assets if those assets have been impaired. So on a routine basis, we do recognize depreciation each year. That's our systematic and logical method of recognizing the cost of the asset over its useful life. But we also have cases where an asset has been impaired. So if the ability of the asset to generate income has been impaired, it has to be written down. So we have to recognize an impairment loss. And for our purposes, what we're going to do is whenever the undiscounted, okay, so that means we don't consider the impact of interest. We'll get into present values later. When the undiscounted future cash flows, the amount that can be generated is less than the recorded book value of the asset, you have to write it down. So here, if someone, a couple of you again are looking at impairment, you're looking at the impact of COVID. So look what Marriott is saying here in their, as of their first quarter of March 31st, 2000 income statement. Okay, they said in the first quarter, we recorded impairment charges of $74 million for the right of use assets and $16 million for property, plant, and equipment related to the impact of COVID-19 at their leased hotels. So Marriott did a calculation, and they said as a result of the COVID restrictions, the ability of the right to use assets, that's probably leased assets, they had the amount of cash that those things could generate was $74 million less than the amount that could be carried on the books. And same thing must have happened to their other property there. 16 million for property, plant, and equipment. So what happened is the ability of those assets to generate future cash flows was impaired. So impairment means when the ability to generate the cash flows from a long-lived asset, whenever that amount is less than the book value, you have to recognize an impairment loss. And the actual calculation of the loss is a bit more complicated than that, but for our purposes, just know what causes an impairment loss. Okay, so the asset has lost its ability to generate future cash flows. We do have market value accounting. We don't have it in the US for long-lived assets, but we do have it for marketable securities, which we'll learn about in Chapter 8. But other countries allow adjustments to market value. So you have this in the UK, Australia, New Zealand. Okay, what happens is the company has an option of valuing its assets upward to reflect their market value. When they value them upward, they're going to have a special stockholders' equity account, which is called the asset revaluation reserve. All right. So this may seem strange. This does violate historical costs. So again, we don't use market value to recognize increase in market value in the US, but under other countries and under international GAAP, they have the option to do that. So remember that little subtlety there when you do the first discussion question that I assigned. So what happens when we sell or retire long-lived assets? Okay, so a couple of things have to happen. We've got to get the asset off the books. We got to get the accumulated depreciation off the books. And we may have a gain. So if the amount that we received is greater than the book value, we have a gain. If the amount that we receive is less than the book value, we have a loss. And let's stop here with an actual illustration where we show how to calculate the gain or loss. So we had an espresso maker for $700. No, they sold it for $700 and originally cost $4,200 when purchased in year one and had a current book value of $1,300. Okay, so when this asset is sold, we've got to get the asset off the books of $4,200. We've got to get the accumulated depreciation off the books, and it looks like it had a book value of $1,300. So the difference between the $4,200 and $1,300, that would be the accumulated depreciation. Okay, and it was sold for $700 when it had a book value of $1,300. So first thing we do is, what is the gain or loss? So take the sales price, which is $700, subtract out the book value of $1,300. So we have a $600 loss on the sale. And here's how we get this thing off the books. Right. So we got to accumulated depreciation was $2,900. That was the difference between the 42 and the 13. So get that off the books. So so the accumulated depreciation is reduced, and you're going to also get the depreciation expense off the books, okay, that you had recognized previously. And then there's your gain or loss. There is $600. So you get the equipment off the books, you get the accumulated depreciation off the books, and you end up with a $600 loss. Okay, so the rule of thumb here is to get the gain or loss on the sale, compare the proceeds to the book value. If you get more than the book value, you get a gain. If you get less than book value, you get a loss. All right. So there's the actual sale. So you're increasing cash, you're reducing equipment, you're reducing accumulated depreciation, and then there's your loss on the sale. All right. So let's stop here. So that $600 loss is reported on the income statement. It's a non-recurring expense. And let's take a break, and we'll come on back for part C, where we'll describe the intangible assets. Right? So hasta luego, au revoir. Take a break and then come on back for part C. See you later. Bye-bye.